Hey, it's Michael John Mountain. You can go to my website, michaeljohnmountain.com, and sign up to learn and get the education on what to do with your money to make more money, to get an exceptional return on investment with your money. You might be a successful business owner. You might own a small business, or you just might be a professional. You might just have a really good career, really good job. You might be a technology professional, a financial professional. You might be a paralegal, or you might be a nurse. You might be doing anything where you get paid very, very well. And now, or you might just be starting out your career. You want to learn, well, what moves am I supposed to make in the next 6 months to 12 months to become a multi-millionaire? Well, I have a program where I could teach you about what to do with your money to get exceptional returns. And I'm not talking about mediocre returns, because, the default plan kind of sucks. Anyone that's been following the markets recently knows that the S&P 500 stock market index is down. So people have lost a lot of money in their retirement accounts just by investing in these index funds that have mediocre returns. If you're taking regular advice from other people, you might be positioned in a 60-40 stocks to bond portfolio, and that kind of sucks too. And let me tell you, there's a lot of people, including myself, that are making exceptional returns and are outperforming the S&P 500 by many, many multiples. I'm talking about 4 or 5x on an annualized basis for the past, 6-7 years. And we're doing that consistently. I mean, am I Warren Buffett? I don't think so. Have we had a good run in the stock market? Yes. But these returns are totally possible, and it's totally achievable just by being able to anticipate market trends and knowing the range of options and the range of different companies you can invest in to maximize the returns on your investment. I'm going to explain all of that shortly. But all I want to convey is that the regular path of taking your money and investing it is crappy. It's terrible. And there's great investments out there. And yes, you can beat the markets. You can achieve a great return in the marketplace if you know what to do. If you know how to anticipate risks, if you know where to position your money, if you know what the next events are going to be, if you know how to read financial statements, if you have all these different range of skills that I teach, you're going to be able to make educated decisions, and not instantly, not like a day trader make really good returns, but I'm talking about over a period of 3 to 5 years, you can have exceptional returns that outperform the S&P 500 index. And you can anticipate risks. So you can anticipate market downturns. You can know when a market is overvalued. Like we recently saw the S&P 500 at insane valuations. And you can know when companies are insanely overvalued or doing something really ridiculous. And you can pull your investments out of those companies and optimize your investments in a way where you're going to maximize your returns. All right, so I wanted to give you a current market analysis and kind of tell you where we're at in the financial markets, what's going on, what is the situation economically in the entire world right now, and I guess space too. But it's impossible to explain everything. I mean, I'm very in tune in the markets. I'm very plugged in, and I look at a lot of different details. So in a little video like this, I can only give you a very cursory view and give you a few bullet points, but I'm going to explain some of the most important elements so you have something to go with. If you want to do something a lot more in depth and understand every little nuance, every little detail, you would have to join my multi-week, multi-month program to kind of learn all that. But right now, it's early 2025, and it's Q2, and the S&P 500 is down. The markets are down. If you look at the media right now, there's a lot of misattribution. So the media always has a narrative on what's going on and why it's causing the market, why the market is going up and down. But the reason the S&P 500 is down dramatically, it's basically just a correction, is because it was just overvalued. I mean, the market went crazy last year. I think it returned over 20%. Which is unheard of. I mean, in a market that's supposed to return 7% on average or 6% on average, depending which way you look at it. The S&P 500 returned way more than that, right? So it was over 3 times that. And it was just basically overheated. So valuations got too high. And this is something most people don't understand, because most people that comment on the stock market only comment about prices. And when you only comment about prices, you don't really understand the stock market. But the prices got too high, even though the economy and economically, in terms of corporate earnings, in terms of other factors, the health of these corporations, the corporations did really, really well. But the prices outpaced the corporations, and they just got to like a very crazy level. And it's almost like a bubble-like level, almost like 2000 type level, where anyone that's been paying attention, anyone that has any clue about the market, could have told you that 2025 was going to be the year where the market was going to correct and valuations were going to come back down, because typically valuations don't stay up that high. It would have been a very unusual year if valuations didn't come down. So the fact that the market corrected is not something that should be a surprise to anyone. If that is a surprise to you, if you're panicking right now, if you're freaking out, if you're one of these people in the news, in the media, or on social media that just kind of having like a freak out right now, this is more reason you need to get a financial education. This is why I teach this stuff, because this was entirely foreseeable and it was entirely predictable. And basically, we're just having a market correction. So that's the most plausible explanation. You don't have to get into political stuff or, all these other explanations of why the market's down. The market's not, the corporations in the United States are not doing poorly. They're actually doing really, really well, but they needed to get revalued, and sometimes revaluations happen. So the S&P is down. There were some good buy opportunities. I took advantage of them. I picked the market bottom. Some people say you can't time the market. I can time the market. I'm one of those weird people that times the market, and I've been doing it for many, many years. Sometimes I predict recession too much. So 2022, 2023, certain years, I do get a little too pessimistic. But generally, you can get a good feel of the market, and you can kind of feel where the market bottom is. So the good news is I don't see any reason to panic right now. And the revaluation is a totally foreseeable thing. And if you know what to look at, you're going to see some good opportunities to buy right now. This is not the time to go in the bonds. It's a terrible advice. This is the time to buy. If you were buying last year, this is a better time to even buy than it was last year. What we're finding out, number 2, is that gold is real money. Right? There's always been this idea that gold is kind of worthless. That's also kind of the Warren Buffett idea, that gold is really just something that you should never put money into. Gold obviously doesn't have a return, right? Gold doesn't produce earnings. So gold isn't really an investment, but gold is money. Gold is an insurance policy. And at least for my lifetime, we never really understood that too much. I mean, there's been a little bit run up in gold, but it's never been this extreme. And if you look at the past 5 years, gold has actually outperformed S&P 500. I actually invested in gold in 2019. So I totally saw the run up in gold in 2020, 2021, etc. But I never predicted that it would run up to this level. I mean, gold is over $3,000 an ounce right now, and we're learning why gold is so important is because in periods of revaluation and periods of changes with currencies and uncertainties related to government solvency, gold becomes a very important asset class. But it is my opinion right now that if you're trying to chase gold right now, you're a little bit late to the game. You should have bought gold in 2019. So, I could go a little bit more in depth on gold, but I've been tracking that market for many, many years. But it should be a part of your portfolio. But if you're trying to rebalance your portfolio now and you're like, oh, gold is important now, and you haven't done that 2 years ago, 3 years ago, 4 years ago, 5 years ago, 6 years ago, I mean, you're kind of late to the game. So this is why my approach is to anticipate the next move, anticipate the next thing that's going to happen, the next trend, the next major event, and not look backwards, not kind of trade with momentum where, oh, gold's going up, so I got to get into gold. Well, now you learn why gold is important. You need to keep that in mind for the next 5, 10, 15, 20 years. But don't get too excited about gold right now because there are plenty of other opportunities that are much better and have much higher potential, which much lower risk of loss of capital. So the other thing that is clear is the reason gold is running up, it has to do something with the United States government and its solvency. The United States government has a spending crisis. I mean, its deficits are way too high. The government is refinancing, or it needs to refinance a lot of bonds this year. And basically, there's this big problem of whether the government will be able to make its interest payments. So it's a big problem. I mean, the government is exactly like it's not exactly, but the government is much like a personal financial statement. I mean, when you're just running up debt over a long period of time, over decades, eventually that debt catches up, and it's going to affect whether you can pay it back, right? And the government right now, there's a big question whether the government's going to be able to pay it back or if they're going to have to print money. And if the government prints a lot of money to pay down its debts, I mean, obviously, that's why gold is running up, because people are kind of anticipating that, right? So right now we're in a spending crisis. The new government that was elected this year was supposed to address the financial crisis. We've heard about this guy, Elon Musk, and he created this agency called Doge, whatever it's called, and he was supposed to cut government spending down at a rate of $4 billion a year, but it looks like he actually failed. It looks like $4 billion a day isn't being cut. I mean, that's like an extreme amount of spending that needs to get cut. And it looks like if you keep track with that, the government is probably not going to cut $2 trillion from its annual deficit, meaning the government's running about $7 trillion deficit a year. A $2 trillion deficit with a $7 trillion total spend. And it looks like they're not going to cut $2 trillion in debt. So that creates a lot of problems for people that are trying to anticipate the future. And it looks like the government might not be able to cover their expenses without printing money. So basically what's going to have to happen is the U.S. central bank is going to have to print money, increase the money supply. And obviously that creates inflation, and that creates a whole new set of problems. That's something we're anticipating right now, and we're positioning ourselves for that eventuality. A lot of things can happen before something extreme happens in terms of a high inflation rate, but it's something to anticipate for the future and to position yourself properly so you can be in the right asset classes that are going to be appreciating during a period of high inflation. It's not always the asset classes that you think. Lastly, I think the tariffs are overblown. Everyone in the media right now is talking about tariffs. A tariff is not a tax. That's just gaslighting. You hear a lot of people in social media and the media just constantly repeating this mantra: a tariff is a tax, a tariff is a tax. A tariff is not a tax. A tariff is revenue for the government. So the government does take in money from tariffs so it could pay down its debt, hopefully, and kind of clean up its balance sheet. But a tariff is not a direct tax on United States consumers. And here's why. Because as a consumer, you are not obligated to purchase foreign goods. So even, so since goods are being imported, for example, from China, I don't have to buy Chinese goods, right? So if tariffs go up 150% on like something I'm purchasing from China, I don't have to buy that product at, 100% 50 with the 150% tariff tacked on top of that good. I could just shift my purchase decision to something else. I could buy something domestically, or I could buy something from a different part of the world. And that's just the basic logical piece that gets kind of over, that's really not talked enough in the mainstream media. And basically the tariffs are being blamed for everything. I mean, that's the primary narrative right now in the financial press, where everyone's talking about tariffs. Everyone's talking about how it's affecting the S&P 500. But here's the reality. Most corporations, I worked for, a few different corporations. I was a business analyst myself. And let me tell you this. A lot of companies aren't doing more than 15, 20, maybe 30% of their sales overseas. So a lot of these US-based corporations, if you're doing 80% of your business in the United States, it doesn't really affect your revenue that much. Cost of goods sold. There's this big argument, well, it's going to increase cost of goods sold if all of a sudden cost of goods sold are going to hike up. But actually, if you look at the profitability of a lot of companies, it's not based on gross margin from having really cheap cost of goods sold. Most of the margin is going to be made up of brand value. And there's specific ways you can calculate that for every company. But, if you have a strong brand, if you have really good marketing, that makes your profit margin a lot higher as opposed to cost of goods sold, which is kind of an old model of, like I import this for X amount of dollars and then I charge an extra 10% on that good. No, it's not really like that. I import this product for X amount of dollars and now I sell that product for, a 300% markup. So if if the tariff is increased 10 or 15 or 20%, I mean, it cuts into the margin a little bit, but it's not extremely consequential. And then there's alternative supply chains, right? So obviously this is a big circle jerk. It's a big, topic. There's a lot of political controversy around tariffs, but basically the government needed to implement tariffs because, like I said in the previous point, the government doesn't have enough money to cover its deficits. So they needed a new revenue stream. So that's precisely what's going on with that. And the tariffs did not cause the crash. So I get a lot of questions. I get a lot of people messaging me all the time, like, what do you think about this tariff? What do you think about that tariff? Well, another thing people don't notice about the tariffs is that tariffs are going to open new export markets for United States-based companies. So if you're invested in the United States, new markets are going to open up all of a sudden. right? Because the point of the tariffs is to negotiate with other countries so they open up their export markets. So, for example, Japan, we can now export cars to Japan. That would be an ideal scenario from the tariffs. Or more energy can be exported to Europe and South Korea, or something like that, right? So it's not entirely negative for global growth. And in fact, it's going to renegotiate a lot of terms and situations and open up new markets for American companies. So, but overall, if you actually look at the hard data, the economic numbers, like the tariffs are not affecting companies as much as you think. And people that are saying that are really just panic mongering. So stop thinking about tariffs right now. It is an important issue, but it's more like number 7 out of like the top 10 most important issues. Like, you shouldn't be putting your primary focus on tariff and tariff policies unless you run an import-based business, which is a little bit different. So you're going to have to realign your supply chains, right? But as an investor, whatever, right? Like I said, the primary reason the S&P is down is because of revaluation, and that was completely seen. These tariffs are not like some like unpredictable thing. I mean, like the current administration's been talking about that for literally decades. I mean, it was completely foreseeable. So if that was a curveball for you, I don't know what to tell you. You should have anticipated that. But yeah, that's kind of the situation we're in right now. So the next question is, how do I act on this? What do I actually do in the current financial market given what's going on? Well, one of the questions I get is like, should I invest in a leverage ETF? One of my friends actually messaged me about 2 months ago, early 2025, Q1, and they ask, should I put my money in the leveraged ETFs? My answer is no. Don't invest in leverage ETFs. First of all, there's a fee associated with leverage ETFs, which eats into your capital. So anything you put in there, it's getting a large chunk of that is getting eaten away at fees. The next thing is it's extremely risky, right? So if you invested money in a leveraged ETF at the beginning of the year, and you invested in some, say, like a technology-based leveraged ETF, you probably lost a lot of money because the big Mag 7 tech companies kind of went down recently. And if you had the leveraged ETF position on those companies, not only did you lose, whatever percentage of those tech companies that went down, you also lost doubly or triply, right? If you have like a 3x leveraged ETF. So a lot of people actually had margin calls and they got tapped out by that. So right now is not a good market to be doing leverage ETFs, at least in my opinion. Some people might have some good strategies with that, but leverage ETFs are good for certain situations in the marketplace when it's clear that debt is cheap and that there's going to be a lot of money pumping, and it's very clear what the trend is going to be in the short and medium term. Sometimes it could be a very good strategy, although still a little bit risky. But this is not that time in the market. There's a little bit too much volatility, and that trend is not clear right now, at least if we're looking at the U.S. markets, S&P 500, etc. So I wouldn't be doing leverage ETFs. What about day trading? I think day trading is very overrated. If you're talking about buying, some equity or buying futures or options or something and buying it at like 11 in the morning and then selling it at 3 in the afternoon or something like that, there's a lot of micromanaging that gets involved with that process. And also it's kind of like taking a magnifying glass to a very dynamic market and hoping that you can predict something on a very micro level. Like say like you're trying to predict the growth of like leaves on a large tree or something, and you're taking a magnifying glass, you're using leverage, kind of like leverage positions to, okay, we're going to buy here and sell here, or we're going to sell here and buy here. It's extremely risky, and most day traders lose a lot of money, especially when volatility goes up, right? So some of the best day traders make 60 or 70% a year. And some of them are very, very good. They use different kind of methods with like order flow, price action. But why not just keep your positions open? That's more of the Warren Buffett style of investing. Why not just roll your positions over to the next day and the next day and next day, and do that for 20, 30, or 40 years? Why close your positions at the end of the day? Why only hold your positions open for one day or less than a week? It just doesn't make sense. If you're trading after hours, why just keep it for a short period of time? I mean, to day trade successfully, you constantly have to be trading. You can't sleep, basically. And you have to be very tuned in to the markets. And sure, I mean, there's some certain companies that have certain hedge funds that have very sophisticated positions, but it's just not my style. And most people, most amateurs, most people that are going to be watching this video are going to get crushed by day trading. It's a foolish thing, and it's basically shows a lack of understanding about the markets if you think day trading is a good strategy, because you're missing a lot of other skills that are very critical. And if you're just relying on price action, you're relying on certain order flow or certain small indicators that are going to show you what the next move to make, it's foolish. Don't do day trading. That's not my strategy. There's much better ways, much more consistent ways of investing in short, medium, and long-term cycles to have extreme returns that beat day traders every time. And you also don't get that tax liability too, right? Next, cryptocurrencies. Cryptocurrencies are another speculative asset. There's a lot of people I know that are very well informed on the crypto markets. Some of the people that I know are multimillionaires, decamillionaires. They have a lot of money. They like to mess around with cryptocurrencies. They're kind of like day traders or short-term swing traders. And the problem with cryptocurrencies is there's not a really good thesis around them. So a lot of different cryptocurrencies, people are going to get crushed on. So I'm sure if you invest in cryptos or trade cryptos, you probably experience 80 or 90% losses. I mean, if I'm going to lose 80% on a trade, it's just not something, or if there's a risk of me losing 80 or 90% of a trade, it's not something I'm interested in. It's not something I want to be involved in. It's just the risk to reward ratio with cryptocurrency just doesn't make sense. I mean, there's certain financial, now that crypto has kind of a track record, there's certain financial theories that can explain some of the moves in crypto. For example, global liquidity. If we look at global liquidity, we can say, some of the crypto markets follow that. But, most of it is garbage, like meme coins. I mean, do I really need to trade like a Trump coin or a Melania coin or a fart coin? I mean, it's just absurd. It's not a consistent money-making strategy. It's not a consistent investment. It's not an intelligent investment. It's extremely speculative. And the underlying thesis, if it's just, some of the theses behind cryptocurrencies don't make it sense at all. Like the dollar is going to get absolutely debased. It's just, I mean, even if we experience high inflation, sometimes in periods of high inflation, cryptocurrencies have went down. So sometimes that thesis kind of breaks as well. Point being, there's better ways to make money. That's the bottom line. There's much more better measured ways, and if you're a good analyst, much more risk averse ways, very low risk ways to make money without gambling in speculative assets. And what I mostly see, even with the top crypto traders, is absolute speculation, absolute idiocracy, and absolute just getting slaughtered when completely foreseeable things, like say the bond market or the 10-year yield changes, all of a sudden all these people get slaughtered that are in cryptocurrencies. And it's like, did you not see that coming? Did you not see that you're going to lose, 50, 60, 70% on your on your Bitcoin positions? And a lot of these crypto traders, they were not able to anticipate some of these drawdowns. So it just kind of shows that they're amateurs. Having said that, some people are really good at manipulating the markets. They're market makers. Some of these crypto coins are less regulated. Some of these people have very large bankrolls. They have some sophisticated strategies. So some people are making a lot of money with cryptos. I'm not entirely plugged in with those people, but I mean, if just as a general trader, or someone that's just a general investor, cryptocurrencies are just not something you want to be involved in. It's something that's probably less than 5% of your portfolio, and you're probably better off investing in gold, honestly, if you believe the thesis with global liquidity, high inflation, things like that. So I don't know. That's kind of my opinion. I could go more in depth with that, but I mean, we just want to keep it brief for this video. So what do you want to do instead? What do you want to do instead of cryptocurrencies, day trading, leverage ETFs, these kind of strategies? You want to become a master at financial analysis. And some of you guys that might be CFAs, some of you guys that have accounting degrees, some of you guys that have financial backgrounds, this is where those skills become pretty useful. I mean, they're not sufficient enough to become a very savage investor. But if you can't read a balance sheet, if you can't read a cash flow statement or an earnings statement, I mean, you really don't know what you're doing. So a lot of people really lack this basic skill, and it's actually pretty, it's almost impossible to make money in the markets if you don't know how to be a financial analyst. So what am I talking about? I mean, it's something as simple as looking at a quarterly filing. A lot of corporations just post their earnings, every 3 months, and you can look at their balance sheet. You can look at the way, different financial ratios. You can look at different returns, and then you can look at valuations on these companies, and you can start making very intelligent decisions about these companies. And you can start finding value. It takes time. So you have to invest the time. You have to spend weekends looking at financial statements. The thing is, when you look at a few financial statements, I mean, you learn a little bit. But if you're able to go through, say, 1,000 financial statements, and when you're actually in the markets and you do this over a period of years, you're going to find more and more value, meaning you're going to find better and better companies, because the best way of investing is actually comparing a lot of different companies to each other, a lot of different potential assets to each other. And this is something we teach, right? This is something I teach. This is something you need to read about. This is something you constantly need to practice. You need to have a little bit of a business experience, or at least a little bit of accounting knowledge or know-how. Anyone can learn this. It's not extremely complicated, but you need to know basic things, leverage, valuations, returns. But it's more than just that, right? You need to be able to compare different investments, different companies to each other, and also plug that into a macroeconomic model. So this is something I've always been extremely good at. And that's basically having a God mode view of the entire global economy and understanding all the macroeconomic trends and the interrelations between different asset classes, different economies across the world, and having a general overview of everything that's going on the earth at the same time, and then also being able to zoom in onto the areas that look most promising and most interesting, and understand capital flows between asset classes, between different sectors of the market, for example, and then being able to laser in on that one, say, equity, or that one little asset class, or that one call option that's going to make you incredible returns and big returns on your money. And being a macroeconomic boss it's a little bit difficult. I mean, it's very difficult. You need to be very well read, and you have to be very well attuned to economic conditions. I mean, just the massive amount of data is just unlimited. But eventually you can see and spot certain patterns. You can spot areas of value, and you can see capital flows, and you can very easily anticipate where capital is going to flow into the market. You can also see where the risks are geopolitically and economically, and you could position yourself using your financial analysis skill as well. You can position yourself in areas where you're very highly confident and have a very high probability of making a very outsized return on investment when compared to S&P 500. So that is the way, and that is way more effective than day trading or looking at order flow or some of these other ridiculous strategies I see other people doing, or speculating on like cryptos. Macroeconomics is where the money's at, and something you have to become really good and just kind of have like a pulse of what's going on, and a pulse in the way the economy is changing and reacting to different events. Once you have that pulse, once you have that feeling of different asset classes in the marketplace, that's when the interesting things happen, because all of a sudden now you can see capital flows, and now you can see what asset class and what's going to appreciate. So it's an ongoing study. It's a never-ending learning experience. But if you're able to do that, I mean, the sky's the limit about how much money you can make. Another strategy I like is timing the market. And a lot of people are going to ridicule me on this, but timing the market is actually has been very effective for me. I mean, something like timing the S&P 500, like I said, a lot of people didn't even anticipate that the S&P 500 was going to go down this year. Or like a lot of people didn't anticipate the top in the Apple stock, for example, or things like that. It's just, some of these things are very foreseeable. Some, a lot of investors, like a Warren Buffett, they'll switch their positions where they'll pull money out of their investments. They'll go into cash. A lot of investors are very astute. They might not be timing the market, but they just, like I said, they have that kind of general intuition where they know that this is a good time to invest. This is a bad time to invest. And they have that kind of intuition. I'm able to a lot of times spot market bottoms, and that comes from an understanding of a few different things. One would be sentiment. Another thing would be economic analysis, and 3 would be technical analysis. So looking at prices, right? And when you can combine those 3 factors, you're able to time the market. For example, the other week I bought a very popular stock at market bottom because I was like, okay, clearly this is the market bottom. Consumer sentiment is like this. The economic factors are like this. And looking at the technical, it looks like this is where the day trading skills come in, right? Where you could be like, oh, okay, this is the market bottom. This is the perfect time. And I basically timed it perfectly where I was able to pick the market bottom. So being able to time the market comes from, like I said, from those three skills. That's something that needs to be learned and taught. I can't just explain that in one video. And basically, the next thing that's really hot right now that everyone's kind of overlooking is there's different indices besides the S&P 500. And what I'm learning very quickly is that people are very over-focused on certain asset classes. They're very over-focused on, say, something like the Mag 7, or they're over-focused on the S&P 500. But if you're able to look in areas that other people aren't looking at, the valuations are different, and you're going to find value, meaning you're going to find undervalued equities and stocks. And you're going to be able to pour money into those areas because you're like, wait, everyone's focused on these, 7 companies, or everyone's focused on this index. Why don't I invest money into this other one that's like clearly has great potential, but for some reason it just doesn't get any attention in the media whatsoever. So there are other indices other than the S&P 500. There are other countries outside of the United States. And not everyone's looking at that. So it's a good idea to keep an eye on those other areas, other things, because periods like right now present some really good opportunities to make money. What are some of the other strategies I'm making money with? Distressed investing. A lot of companies, for whatever reason, are selling at like extremely low multiples. I mean, it's almost like they're giving money away for free. I mean, it's insane how low some of these companies are trading at. But you have to do a lot of research, right? You have to be very knowledgeable on some of these niche markets, these niche sectors. But some of these companies have incredible revenue, incredible earnings, for example, incredible growth potential. They're in the hottest area of the market, but they're just getting trashed. Everyone's just trashing them because there's things like accounting issues. And if you're able to decipher and dig through the accounting and read the situation, you have a really good risk to reward where you have, an 100% upside in a period of like 45 days. And your downside is like 10%. You're like, oh my God, why am I not like putting everything I have into this stock? And I've had a stock like that recently, and it's done really, really well for me. Those are really, really effective trades. Certain companies just get trashed and they trade below book value. So they're in a situation where their assets are worth more than the company's trading for. And pouring money into those stocks is a good strategy as well. But you really have to understand and value those assets properly and value it in the context of the company. So, I mean, that's a little bit of a different strategy, but distressed investing is very legit. There's a lot of people making 400% returns, like I said at the beginning of this video. So that's another area to look at. And then lastly, like I said, there's certain equities and certain asset classes that no one even knows about them. What is an equity? Equity is a company, for example, and putting ownership in that company. This company is growing crazy. It has a great outlook. It's in a great sector. But for example, just because its market cap is a lot lower, it's a tiny company. It doesn't get a lot of attention or any media attention at all. You have to understand that company on a more magnified basis. You really have to zoom in and kind of put some focus on that company for a period of time. But eventually you're going to get confident enough where you can pour a large percentage of your cash, of your portfolio into that company and just kind of ride the wave of the growth of the company. So the company's revenue improves, the company's earnings improve, and your investment grows with that company proportionally. There's very low risk. It's just like, yeah, it's going to be volatile. You're not going to have, a perfectly linear increase, but it's just time and time again, I'm taking advantage of some of these companies. And even in the market like this, where the S&P is going down, like these companies are still growing their earnings. And I'm up with these companies, and their growth potential is amazing. I mean, they're doubling their revenue over a yearly basis. I mean, these are very aggressive growing companies that for whatever reason the market is just not putting attention towards. So you have to be very plugged into the markets. And like I said, you need to time the market as well. If you're not timing the market, you're going to buy these companies a little bit too expensive, which is going to hurt your returns. But if you're able to, be comfortable with that volatility, you can purchase some of these assets a little bit less expensive and get great returns. So these are some of these strategies. And like I said, this is just kind of a cursory overview, but that's what you should be doing in the market right now to get really good returns. So Michael Jamau, and I know you're a genius. I know you're doing really well. How do I personally get up and running and start doing this myself? Well, you need to change your mindset, and you need to get plugged in, and you need to learn fast. You need to accelerate the rate that you learn these things. It takes time to consume all the complexity of all the different information that you need to know. You need to know financial accounting. You need to know macroeconomics. You need to have a feel for different market sectors and prices, and you need to study these companies for, at least 6 months or so to really, you're going to have, you can invest in them now and run with them and learn with them. It's not guaranteed you're going to make money, but it's going to be at least 6 months until you have a really good grasp on where you should put your investments in. But the way I look at this is I'm going to be investing money for the rest of my life, right? So I need to front load my education. I need to front load my learning and get this stuff down fast. And that's why I have a program, michaeljohnmountain.com. In my program, you're going to get trained on the financial markets. It's a very intensive program. It's going to give you the best literature on the markets. It's going to give you the best frameworks on the market. And then you're going to be able to develop a comprehensive market thesis. So a thesis is just basically your view on the marketplace. This is my view on what's going to happen in the marketplace. And you're going to have a very intelligent thesis, much like a hedge fund manager, much like a world-renowned investor. And you're going to be able to invest in areas where it's like, okay, my thesis makes sense. And when you have a hypothesis, you have a thesis, it's going to get checked out with actualities. What actually happens in the marketplace? Do your equities go up? Does capital move to the areas you thought it's going to move into? Do macroeconomic trends evolve the way you thought? Or is there a change in your macroeconomic thesis and you see a change in the data and now you need to adjust your thesis? So it's just a dynamic. Investing is a dynamic process. Just like making money. Making money is a dynamic process. It's not stagnant. But you need to start somewhere. You need to develop that market thesis as quick as possible. And then you need to get plugged into the marketplace. So I like to help a lot of my friends develop and get plugged in and to build a financial dashboard. So there's 3 primary things I like to track. I like to track sentiment. I like to track hard data, which is economic realities. And I like to track prices. And I do that on a daily basis, or I do that constantly. I'm looking at these different kind of indicators. And it's much like running a business or much like running your personal finances. You need to check your bank account every single day to see how much, if you're overspending, underspending. You need to keep an eye on these different economic developments. You need to keep a finger on the pulse. When you have your finger on the pulse, you're going to spot opportunities. Things are going to come out at you where it's like, okay, this is clearly a big upside potential. This is clearly an opportunity where I can make a ton of money. I have like money dedicated. I'm doing my risk to reward. This is a good area I'm going to invest in. Here's my entry point. Here's my exit. In 45 days, I might hold on to this for another 6 months. I might hold on for this for another 3 to 5 years. I think there's a long-term potential with this asset class, this equity. And that's kind of how that works. Next, you need to be you need to exchange ideas in the community. So I have some genius mathematicians, genius investors that I can bounce ideas off of, get ideas from, ask questions to, get clarification from, ask for resources. They send me financial reports from the top investment banks. They send me financial reports from different companies. They share videos with me. They share different ideas. They share proprietary information that no one else knows. They share statistics from airports with me. They share different kinds of information you would never even think of. And you can use that data to make better and more informed decisions. And when you're in a community, you're also more motivated because you're like, oh, this person's doing this kind of stuff. They're investing in these kind of assets. Wow, they're getting these kind of returns. Like you do things that you never even thought possible, and you pick up little tips, you pick up little tricks, things like that improve your game, improve your investing, and improve your trading. That's why community is very important. That's something I'm developing and building. I'm building a larger and larger community of very intelligent, very motivated investors and people that are able to anticipate capital moves and areas of high return. You're going to position your capital from your retained earnings. So basically the money that you make, the money that you keep after all your expenses, after all said and done, after you pay your taxes, etc., you're going to use to maximize your return on investment and minimize your risks. So, putting together all the information from the community, from your financial dashboard, your economic indicators, from your market thesis, from your education, from the books, from all the resources and everything you're reading, you're going to put all that together and you're going to create this portfolio, the system of allocating capital, diversifying without diversifying, and basically have a few different things running. So you're not reliant on one stream of income. Now you have multiple different income sources and multiple different asset classes, different investments with different kinds of potential, and you're able to take advantage. Maybe this one investment is kind of getting delayed. Maybe it's taking, longer than the 45-day period you thought it's going to take. It's going to take another, 90, 180 days for this investment to materialize. But you have this other investment going that's actually growing very steadily and very rapidly and very quickly. And you have these other investment that maybe you didn't anticipate the risks, right? But it's part of a diversified portfolio. So you can, generally the magnitude of your gains is going to vastly outnumber the magnitudes of your losses. And over the long run, you're going to have a really good return on your portfolio. And so that's what you're going to achieve and create and do. And lastly, you're just going to profit from that, right? And once you sell off your investments, you find a good point of sale, or maybe you're holding on to that, position or investment. You're going to reposition. The world's not going to look the same in 6 months or a year from now. And there's going to be different ways of making money. So you're going to rethink, reposition as the landscape changes, and make new investments given new information and new realities. So I realized that was an entire mouthful to actually get trained on this process and to get the world-class advice, education, wisdom, community ideas, tools, and to do this on an ongoing long-term basis for the rest of your life so you can make multiple millions in the markets as an investor, you need to join my program. It's at michaeljohnmountain.com. You're going to order the program, and I'm going to get you up to date. I'm following these steps I just outlined with you. Again, it's michaeljohnmountain.com. Stay up to date with my other materials. Like I said, I'm doing this for forever, for the rest of my life. You're going to hear a lot more from me. And when you're ready, you're going to go to michaeljohnmountain.com. You're going to develop that relationship, and you're going to learn how to improve your investments and start making serious money in the markets. Thanks.